Good afternoon. Welcome, everybody. Thank you so much for joining our fourth quarter update call. I'm Jennifer Klein, Head of Wealth Management at Cambridge Trust, and I hope that you have all had a wonderful Thanksgiving and have had time to spend with loved ones, and that you're also able to have some downtime during this very hectic holiday season. We had hoped for all four of us to be in one location today, but COVID had different ideas. So we are yet again on separate screens today, but still looking forward to discussing our outlooks with you. I'd also like to remind you that we're recording this call and it will be posted on our website sometime in the next few days. Also, please feel free to add questions in the Q&A that should be at the bottom of your screen. Today, I'm joined by three of my colleagues, Dave Lynch, Chief Investment Officer, who is quite the pro here because we've done many of these together, Anne-Marie Hanley, Portfolio Manager, and Michael Bannister, our Head of Tax. Dave and Anne-Marie will give us an overview of the markets and our current positioning, and then Mike will share some year-end tax planning strategies. One of our earlier calls this year focused on inflation and interest rates, and this certainly continues to be a relevant topic in the markets. We do expect to hear more in a couple of weeks after the Fed's next meeting on December 14th. Most economists at this point are projecting a recession. I think at this point it's a question of whether it's already started or how deep the recession might be. As you'll see in a few minutes, tech layoffs are starting to happen. We're seeing them at Salesforce and Uber and obviously Twitter, which is its own very interesting story. Anecdotally, as I was doing a little bit of holiday shopping in stores over the weekend, it was extremely quiet. But I think everybody is doing their shopping online because Cyber Monday, I think, was probably the largest amount of sales ever. I look forward to hearing more from Dave and Anne-Marie on that topic and more. Our presentation will go for about 25 minutes, and then we're, as I said, happy to take your questions. So at any point during the conversation, please enter your questions in the chat, and we will do our best to answer those. So Dave and Anne-Marie, I will turn it over to you.
Great, thank you, Jennifer, and good afternoon, everyone. It's a nicer day to speak to you than I expected, in that it was a very happy day for the markets. So portfolios should be up and happy after what were taken as more dovish and benign comments from Jerome Powell at a major speaking engagement today that indicated likely a slightly softer Fed stance, or at least a responsive Fed stance, that they want to be careful about not overdoing it, such that it's now being perceived by the markets that the next rate hike may be more like 50 basis points rather than 75 here in a couple of weeks. All this has served to revive hopes of maybe a soft landing that we sort of have been trying, the Fed have been trying to navigate us toward for some time now. And at least for one day anyway, the market is hoping that may still yet be done, and we shall see. And I want to talk more about that as we go forward. If we can move on to page 3. We just met as a team on Monday in our asset allocation meeting. We meet every 2 months, the 12 of us, really the entire team. There's 12 of us that are primary on the committee, but we bring the entire team together across our Massachusetts and New Hampshire offices, as well as Connecticut, to discuss what the world is facing. And this page here is really to sort of take you inside a day in the life on the asset allocation committee, if you will. And this is how we teed up that meeting on Monday, as we always do, outlining some of the major risks and supports for the market, the yin and yang, the bull and bear of it all. Now, I won't read this entire list to you, but I might highlight a couple of the unique or new arrivals or changing dynamics of these push and pull components to the market. One that I might mention is weather, and that has become a more frequent guest on the risks of our list. if not a permanent one in the age of global warming and so forth. And weather of this nature is more with regard to winter. Obviously, it's going to be a very trying winter in Europe and Ukraine, but even here at home in the Northeast, things like diesel prices and home heating fuel are going to be quite costly. So that's a risk to available capital for consumers and others. So new arrival to the list there, or modified, I guess, arrival there. And I would also mention the China COVID outbreaks, certainly a risk in the sense that the zero COVID policy creates full shutdown and major gridlock over in China and limits their participation in the global economy and the global supply chains. Interestingly, though, there's maybe a little bit of a dotted line almost. This could flip to becoming a support. Should the protests in some measure be successful such that there more of a reopening is allowed and politically in China such that they can participate economically to a greater degree and increase and resume consumption. And so that remains to be seen. That may, in fact, by the time we speak next, start to move over into the support column. So all of this, the bull and bear side of things is all part of risk management. We have to weigh the good and the bad and come out with a net opinion. And one of the things that could be supporting the market is this reset and renewal of risk taking that we could see as the year turns. And we all get a breath of fresh air and kind of a reset of things. And so we talked a lot about that. This all kicks us off toward underwriting and re-underwriting our current positions. And I will cut to the chase. The punchline is we decided to maintain these positions, being underweight equities, being neutral bonds, with an overweight to cash, and a small overweight to alternative investments for those accounts where alternatives would be appropriate. Current format is a call writing fund. So then moving on, getting into the meat of it a bit more. Page 4 here talks about the business cycle, and certainly these circles are trending downward and clustering down towards the bottom. The U.S., among others, moving down deeper into that late cycle or recession, sort of leave that to a degree of academic argument as to whether we are or we aren't in a recession and how to define that. But also mention China there. It's been down, mired kind of in recession, and generally some of the better returns are when you do start to recover up and out of recession. And so we're watching that as well as UK and Eurozone with regard to our international investing, how and when we might increase that. For the current moment, we're not quite ready to do that. On to the next page. There is a variety of charts out there about leading economic indicators and a lot of other gathering clouds, if you will, on the economic and earnings outlook. Now, to some extent, a lot of this is well choreographed and sort of slow moving and is relatively known and consensus. And so that begs the question for us of, is it time to be contrarian and kind of invest more bullishly against the crowd here? We think not quite yet, in that though things are moving to a degree of slow motion, might be considered a slow motion car crash or a slow motion football collision or a football collision for the soccer fans, and a slow gathering storm, but it's still a collision and it's still a storm that we have to get through. So the world is better braced and the hatches are battened down a bit more because of some of the foreshadowing of this. So, there's less leverage in the system, maybe Bitcoin aside, the system is more healthy and prepared than really it has been in prior downturns. But it remains to be seen how big the storm will or won't be, but something we probably will not be able to totally dodge. And therefore, we want to be patient and let some of the weather sort of pass through before we get too bullish. And then so on to the next page. So what are the things, the clouds that are gathering a bit more? And we saw we're in a bit of this transition period there, where in COVID we had savings go through the roof, stimulus checks, et cetera. A lot of that has been spent down, has now shifted to levering back up in terms of the consumer, putting things back on credit cards and driving those balances up. And so once that reaches a degree of limit, there will be further pressures. And what would be the ultimate pressure for unfortunately so for many people, could be, being laid off as the employment picture cools and is sort of intended to cool by the Fed and some of their aggressiveness in their rate hikes. This on page 6 is talking some of what the technology space is doing and accumulating with regard to layoffs. Now, though these grab a lot of headlines, they are actually not in number as large of a part of the employment economy as it might seem. However, they do signal a sentiment shift, including for kind of the white collar worker community as well. And if we move to the next page, there's also potential pressures more on kind of the blue collar side of the employment equation, as well as housing rolls over. Eventually, with some lag, you could see construction employment decrease and have some layoffs. So we put these slides deliberately next to each other, so you have two very different sectors of the economy, but each facing some dynamics and sort of downsizing and resetting of things that could have broader ripple effects. So onward then to the next page, please. Some of the better data would be that inflation is rolling over, and so some of the Fed's intentions are playing through. Some of it's sort of just natural rollover of things as the economy resets itself, and likely more of that to come next year. That's already baked in the cake. And on the lower right of this, you see that we're also getting more of a normalization in spending patterns. As you recall, during COVID, everyone spent on goods, the bottom line there, the darker line, and curtailed and shut down on services spending. Thankfully, due to some COVID relenting, that has allowed people to get back out there on more of the service and entertainment type side of things, and have less need to buy that next refrigerator or laptop or what it might be. But at least to a degree of normalizing in those patterns should allow for better forecasting and management on behalf of the stocks in each of these places. So on to the next page. The bond market has been kind of the star attraction this year, particularly the yield curve and how much it has changed. I think this graph tells a huge story, and it almost understates it, how steeply inverted the curve is right now. We went from 0 at the front end to now 4 and above 4 in the 6 and 2 year type of a window. In the longer end went from 1.5%, 2%. We all remember those low mortgage rates, et cetera. Those are now gone, and things are pricing off of a much higher yield curve further out in the 4% area. And also, so that inversion tends to be a harbinger of recession on just basically the delayed reaction and the working through of the Fed's rate hikes that they have really pounded through the front end of the yield curve. So the next page, so there is good news among this, though, that bond yields have again a seat at the table in terms of how you might want to allocate your portfolio, how we are able to diversify in a better way. There was a time where there were no other alternatives. It was hard to diversify away from equity risk because bonds offered next to nothing and cash rates offered next to nothing. Now that has changed. And so corporate bond yields that we're showing here, the higher grade investment grade bond yields are the white line at the bottom. Those are yielding in the 5.5% area, not that far off their recent peak. And higher yield bonds are up in the 8 to 9% area. So, competitive and attractive and offer a good spot in portfolios. Again, onward then to the next page, the dollar. We're not in the currency market here directly, but it has a lot of indirect effects that are becoming more and more prominent because of the massive run up and appreciation that the dollar had relative to the rest of the world. In large part, some of that was capital wanting to come into US stock markets, but also to come in to take advantage of the Fed rate hikes offering better interest rate yield differentials. Some of that has started to shift, and so we are factoring that in our analysis in a few ways. on multinational companies. So even if we're in US-based companies, many get much of their revenue, if not a majority of their revenue, internationally. So it is a dynamic that is playing out in current earnings calls, as we speak and finish up the earnings season here. It also impacts how we think about investing in international markets, both stock and bonds, because if this could become what had been a headwind, could become a favorable tailwind to further support the returns of these markets in dollar terms when they're translated back into your portfolio. So that's my roundup of all the other sides of the market. And we leave the sort of star attraction of global equities to my colleague Anne-Marie Hanley, and she's going to take us through a bit of a deeper dive on things like earnings and our forward-looking scenarios. So thank you. Over to you, Anne-Marie.
Great, thank you, Dave. Well, since we're just a month away from closing out 2022, I'm going to recap the year in equity markets, as well as highlight some of the things our investment team is seeing now that Q3 earnings season is behind us. Well, it's been quite the year. Michelle, if you want to move to the next slide. It's been quite the year. We came into the year with stock valuations at highs, having finally gotten to a better place with COVID, enjoying 3 straight years of double-digit returns, interest rates effectively at 0, and the Fed calling inflation transitory. Here we sit about a year later, having undergone 40-year highs in inflation and CPI, bear markets for the Dow, S&P 500, and NASDAQ. The S&P 500 was down 24% at its low this year, but we've had some nice tailwinds recently over the past month, with CPI coming in below expectations and markets starting to price in a slowdown and eventual pause in the Fed's tightening. We also have some unknowns behind us. We have the midterm election for the most part behind us. Q3 earnings season is in the rearview mirror. And year to date, the Dow is down 5%, the S&P is now down 15%, and NASDAQ is down double that at 30%, on track for its second year of lagging the S&P. Moving on to the next slide. So this is a bar chart of year-to-date sector performance through last Friday. You can see the rotation from growth to defensive sectors that started last year has continued this year. Energy is the clear year-to-date winner, up over 70%. Followed by utilities and consumer staples that are just barely positive. The growth sectors that were so popular for the decade leading up to and through the pandemic have underperformed, to say the least. You can see that on the chart. And we'll talk about the shift in a few minutes, but clearly value is in the lead this year. Moving on to the next slide. This shows the aggregate S&P 500 earnings that they've held in this year, albeit in a single-digit growth range. The chart on the right shows the decline in the market has been solely a function of a decline in the price to earnings multiple, PE multiple. The black line depicts that earnings growth is slowing, but still positive this year, while the blue line shows the PE multiple decline of 19%, which has really driven the market down at this point by 15%, depicted by the green line. The multiple compression is a result of the Fed raising rates at the fastest pace in history. We're up 400 basis points since the start of the year, and that's made investors less willing to pay up for earnings than they have been in the past, especially for those growth stocks that generally have earnings that are further out in the future. On a positive note, though, a lot of the froth has been taken out of from the last few years, and valuations have come down. Moving on to the next slide. This shows the historical price to earnings ratio. We came into the year with a multiple of around 22 times, and now we're at 17 times, which is right in line with the 25-year average. So you would think that we're fairly priced, but at this level, but really our concern is that earnings, the E in the denominator of the PE ratio, needs to come down, so the market may not be as reasonably priced as it appears. With the drawdown this year, valuations do look better for sure, but they still don't look cheap to us. Moving on to the next slide. So this shows the progression of earnings analysts' earnings estimates for the S&P 500 over the course of this year. You can see that they started coming down over the summer. The blue represents 2022 estimates. The red dotted line is 2023. And the current estimates are now for growth of 5% this year and 7% next year. That's progress, but profit margins are still high and coming down. S&P 500 margins declined by about 100 basis points year over year in Q3, and they usually come down further than that, than current levels and various slowdowns and recessions that we've had in the past. Management teams have been certainly cautious. During Q3 earnings season, 70% of those S&P 500 companies that gave forward guidance issued lower guidance, and analysts are now forecasting a slight decline in fourth quarter earnings. Again, this is progress, but as you'll see in the next slide, we think they have further to go. So this chart shows peak to trough declines in S&P 500 earnings during the last 12 recessions since World War II. Some are deeper than others. You can see especially the financial crisis down 45%. But overall, the median earnings decline over all those recessionary periods has been 13%. So again, Wall Street's expecting 7% growth next year, but given our outlook on the economy and these historical results, you can see why we think they need to come down further. So I'll just pause here and say that despite our cautious outlook, our investment team is navigating this current environment very well. We're still identifying companies with competitive advantages, pricing power, and that are being disciplined in their expense management. So we think, we're set up for them to outperform in the long run. Moving on to the next slide. Taking a deeper dive into Q3 earnings results, overall, with 97% of companies having reported, we've had blended revenues grow by 11.5% and earnings growth of about 3.5%. I will point out that Q3 showed more sales growth than earnings growth, and that's a result of that margin decline that I mentioned earlier. The clear earnings winner this quarter and all year basically has been the energy sector with 150% earnings growth in Q3. In fact, if you took energy out of these numbers, earnings would have declined by 3.6% on an aggregate basis. So it's clearly been the main contributor driving earnings results, similar to what we saw in Q2, which is also why energy has outperformed so much this year. Moving on to the next slide. So the next slide, it shows a major shift we've seen in the market over the past year. As I mentioned earlier, value is taking the lead over growth after a full decade of technology being really the main driver of returns. As we all know, growth valuations were bid up to extreme levels, especially over these last few years during the pandemic when we were all stuck at home, as well as all the excess cash in the system from fiscal stimulus and the Fed lowering rates to zero. So valuations were very high at that point. We started to see the shift toward value when it was evident that the Fed would be raising rates. Higher rates reduce the value of longer duration assets, and thus growth stocks have suffered. So to quantify this year, the Russell 1000 value index has outpaced the growth index by a full 20 percentage points year to date. And the Dow, which is more value heavy, has outpaced the S&P 500 by 10 percentage points. It's debatable and hard to predict whether this rotation will continue, but given all the moving pieces in this market, sentiment can shift at any point. But from a Cambridge Trust perspective, we've increased our exposure to value in defensive areas of the market that should do well in this environment, but we do continue to hold quality growth names as well. And most importantly, our team is continuing to stay true to our fundamental discipline, which has always been focusing on the quality names, the good free cash flow, consistent earnings growth, strong balance sheets, and solid management teams. Moving on to the next slide. This shows how U.S. equities have outperformed international equities for extended periods of time, and they do continue to outperform this year. The gray areas on the chart show U.S. outperformance, and purple shows EFA, which is the international index, those years of outperformance. So we continue to maintain our underweight position in international equities as we're concerned about the ripple effects of the Russia-Ukraine war on overseas economies, especially European countries. We do continue to keep a close eye on these events, though, and we may add exposure when we feel that the risk reward is favorable. All right, moving on to the next slide. Finally, while it's been a challenging year in markets, equity valuations have certainly come down, and this slide shows what returns have looked like after all of the bear markets since 1987. The orange bars show peak to trough losses in those years, and the yellow bars show returns over the following 12 months, which is encouraging. As I mentioned earlier, we were down by 24% in October from the peak, and we've gained about 10 percentage points of that back at this point. So year to date, we're down 15%. The chart shows 24 because that's peak to trough. But while we don't know that we've seen the bottom, we don't know if the bottom's in yet, and likely we will see more volatility ahead. We're staying the course and keeping the long term in mind, and we are definitely finding ways to profit in this environment. So with that, Dave, I'll pass it back to you.
Okay, great. Thank you, Anne Marie. And I will bring us in for a landing and conclusion here. So quite simply, the conclusion, we're not out of the woods yet, is what we think. Today's happiness aside, as fundamental investors, we believe the fundamentals still have a little more to work through and are not really completely out of the woods. The good news, though, is the longer horizon is undeniably looking better from these starting prices after this year's pain and the higher bond yields that I mentioned, particularly for those accounts that are able to invest in individual bonds, because you're really locking that bond yield in for the life of of the bond. Equity prices will sort of bounce around, go up and down a bit more. That hopefully will compound positively over the long term. But bonds, it's a little more of a predictable outcome when you are able to invest individually at these better starting yields. So the fundamental question that we're going to be watching as the weeks and quarters and months go forward here is, can the market, and in this case earnings, as fundamental investors, withstand higher rates and some of the pressures that are and lagged effects that are still going to be working their way through the economy, such as potentially some layoffs or at least a cooling of the labor market, some of these winter price pressures around higher energy costs, diesel costs, et cetera, and geopolitics really run the gamut throughout. And so we have new news every day. We have a huge payroll report coming up on Friday, for example, as one of the next big touch points coming up. And so that's where we are. And I'll move us forward to the next page before I hand it off to our next speaker. I just wanted to provide a little bit of a shout out to the new monthly piece that we have available. So hopefully you all are on our mailing list and you get this nice 2-page summary of our adjustments and latest thoughts to the news of the moment. This first page really summarizes some of the different aspects of the economy and statistics. And then the second page highlights those positions that I discussed at the beginning of the call and really how it all boils down to us at the different major asset class levels. And then of course, always portfolio manager, relationship manager can answer any more specific questions that you might like. We hope this helps kind of keep you in the loop between our more formal quarterly letters or these more formal conference calls. And and onward to the next speaker. Taxes have been a major consideration throughout the year, even within the investment team, both on tax management on the equity side, and this year, even in the bond side, which is sort of hadn't been part of the equation for a while. We've been doing a lot of tax management across investment portfolios. But above and beyond that, we have further tax expertise here at Cambridge Trust, and I'm going to hand it next to our head of tax, Mike Bannister, to talk about a broader, deeper dive on savvy tax management in the current upcoming year end and onward into next year. So over to you, Mike. Thanks.
Thanks, Dave. Hi, everyone. Mike Bannister, as Dave and Jennifer said, I'm the head of tax here at Cambridge Trust Wealth Management. I wanted to talk today about kind of what are we looking to do in the next month, what are we looking to do in the next year, and just some miscellaneous tips at the end. And we'll also look at the IRS has come out with the 2023 numbers for standard deduction and all of those updates that you do on a yearly basis. So if we could please go to the next slide. Okay, so in the next month, what are we looking at? So if you have to take an RMD, that has to be done by the end of December. So you roughly have a month, since obviously tomorrow is December 1st, to take that RMD. So you should be having those discussions with your relationship manager now, or wherever your IRAs are, and be taking those distributions if you haven't already. If you turn 72 in 2022, you actually get a little bit of a buffer here. This is what's called your required beginning date when you turn 72, and you can actually take that RMD up until April 1st of 2023. So they give you about 3 months there extra. Maybe you're trying to figure out what your number is. It's the first time you've had to do it. They give you a little bit of a grace period. What's the problem with that? Well, basically, you're probably, if you wait until, let's say, March 15th, you're going to have 2 RMDs in 2023. So your first one would be technically your 2022 RMD, and then your second one would be your 2023. So you certainly can do it, but you want to keep that in mind that if you do wait in that first year when you turn 72, you're going to have a little bit more income. Going on to the next bullet. If you have, just to go on to the next bullet. If you have capital gains during the year, because of the downturn in the market, you probably want to think about, should you be taking losses against those gains? those are conversations that, we would have here with your portfolio manager. And just basically, as Dave said a couple minutes ago, they're keeping an eye on these things. The last thing at the bottom there, just maxing out your retirement accounts. If you haven't already, and if you're able to, obviously, the more the better. But with a 401k, you can do 20,500. And if you're over 50, you could do 27,000 even. And with an IRA, you could do 6,000. Or if you're over 50 years old, you could do 7,000. So basically, the point of this slide is, what should you be thinking about in the next month? Sorry, go ahead to the next slide now, please. So if you are in an RMD situation, what's an idea that you could do if you are charitably inclined? Well, one of the things you can do is what's called a qualified charitable distribution. And for short, we call this a QCD. And basically the idea here is you take your IRA, and a lot of times it's your RMD, you take your RMD and you give that money directly to charity. So there are a couple stipulations here, a couple of qualifying things. You have to be 70.5 years old, which is the second bullet point. And you can only do it up to $100,000. So let's say your RMD was 300,000. You could only do up to 100 as a QCD. The advantage to this is that income will be on your 1040, but it will not be taxable income. So for example, what we do here at Cambridge Trust is we say, we give you your 1099-R, we tell you what the distribution was, and if all of that distribution is a QCD, we put a little footnote on the bottom of your 1099-R so that we can tell yourself as well as your tax preparer that yes, you had a distribution, but we expect it to be a qualified charitable distribution. As I said before, the third bullet point in RMD, oftentimes an RMD is your QCD. If let's say it's $10,000, you could do that amount as a QCD. So your RMD can be satisfied with a QCD. And the last bullet point we've had a couple questions here recently about this is some people choose to give to charity through a donor advised fund. Well, that works, but it doesn't actually work for QCDs. So just keep in mind that if you are charitably inclined, a QCD is an option, but a donor advised fund does not qualify that. So just to give you a hypothetical example, let's say your RMD was $10,000, you would give the money, let's say if you wanted to do all of it, you could give $10,000 to, for example, the Red Cross or something like that. That would be the idea behind a QCD. Next slide, please. So just to give you a quick little story here, I was at a conference a couple weeks ago down in Pennsylvania, and one of the things that the tax professionals and we had our own little group breakout session there at one point. A lot of us were talking about this slide. And what this slide is when an IRA, primary owner, someone who created it, when they pass away, the rules have changed recently for deaths after 2019, basically, as you can see in the first bullet point. And what the rule did was with the Secure Act, this rule changed to say for non-spouse beneficiaries, the IRA has to be withdrawn completely within 10 years. That's a change of what it used to be. But the thinking at the time was, when this first came out, was okay, well, I could distribute it all in year 1, year 10, I could take 1/10 for 10 years. Basically, I have flexibility. Well, as you can probably imagine, the IRS said, whoa, hold on a second. In the second bullet point, there were proposed regulations that came out in the springtime of this year, 2022. And they said, well, instead of saying you can take it all, as long as it's out within 10 years, we don't care. Instead of saying that, they said, well, we think we're going to require you to take basically an RMD during that 10-year period each year. So it would probably be based on your life expectancy. So there are IRS tables, and you would look at the tables, you would look at the prior year value, just as you would any other RMD. But the point is that with that second bullet point, these are only proposed regulations. So the third bullet point says the final regulations have not been released. but there was a very important notice that came out just last October, just last month in October. And it said, this notice 2022-53 said, okay, we're going to give those final regulations, we're going to distribute those final regulations shortly. But in the meantime, if you are in this situation where you, again, you're a non-spouse IRA beneficiary and you have not taken an RMD in 2021 or 2022, let's say, we are not going to penalize you. They're basically saying, we understand we have not finished these regulations. We understand there's some ambiguity out there. We're going to give people basically a great, a pass on this one. So the point being, in the next month or so, if you're an inherited IRA beneficiary and you have not taken an RMD, it looks like that's okay. Well, that is okay based on this notice 2022-53. So it's yet to be seen whether in 2023, if the IRS is going to require an RMD in a non-spouse inherited IRA beneficiary situation. And then the last bullet point, I just wanted to kind of, while we're on the RMDs and an IRA discussion, there is a Secure Act 2.0, they're kind of dubbing it, that's going through Congress. It's kind of stalled in there, but basically they're saying that there could be new legislation, the Secure Act 2.0, that actually increases the RMD age, what I mentioned before, the required beginning date. So right now it's 72 years old. They're looking at maybe 75 years old. So these last couple bullet points are saying there might be more to come. Next slide, please. So I know I've talked a lot about IRAs, RMDs, year end. I wanted to just basically give a couple, year end thoughts for taxes, maybe some tips and tricks and something that I've seen. So for example, the first bullet point, during COVID, the IRS allowed you to deduct last year in 2021, up to $600 of charitable contributions if you did not itemize your deductions on your 1040. This basically said, well, we want people to be charitably inclined during COVID. Normally, people that don't itemize do not get a charitable deduction or the benefit of a charitable deduction. We'll give you $600. That actually expired with tax year 2021, and it was not extended. So just to keep it in the back of your mind, if you are not itemizing for 2022, the charitable deduction is up to $600 has not been extended. For those clients out there who are maybe have young children, are thinking about a college for those children, and are thinking about a 529 plan, there has been for a few years now, I think 2017 to 2021, a 529 college savings plan tax deduction. But that was set to expire after tax year 2021. But the Massachusetts government actually made it permanent now. So if you're thinking about, I've got children at home and I'd like to create a 529 plan for them, we plan on them going to college, this is now a permanent deduction. Another thing that just a little tip, if you pay rent in Massachusetts, and this is, to live, this isn't a business or anything like that. If you pay rent in Massachusetts, you're allowed up to a $3,000 deduction per return to deduct on so Form 1 is the Massachusetts individual income tax return. So just keep that in mind. If you pay rent, let your tax preparer know. And then the last thing, just a year-end thought, review your estate plan. This doesn't necessarily need to be a yearly thing, but every couple of years, you should probably take a look and say, does my estate plan still meet my goals? Maybe you created it when you had younger kids, maybe when you got married. It's probably a good idea. Maybe it's been 20, 30, 40 years to say, is my executor still who I want it to be? Is my beneficiary still who I want it to be? So, talk to your estate planning attorney and consider if your goals are still being met with your estate plan. Next slide, please. And the final slide I have here was just, we talked about 2022. What are we looking at in the next month? What are we looking at in the next year or so with, inherited IRAs? What are we looking at? This slide tries to get at what are we looking at for, index numbers, basically 2023 tax year numbers. So as you can see at the top, retirement contributions, those numbers have gone up a bit. So 401ks, you could do up to 22,500. 30,000 if you're 50 or older. For IRAs, this includes traditional and Roth. You could do 6,500 or 7,500 if you're 50 or older. And a SEP IRA, if you own your own business, that's up to $66,000 in 2023. SEP IRAs actually do not have a catch-up, as they call it, that we see for the other 401k or IRAs. SEP IRAs are just a flat 66,000. The standard deduction, married filing joint, is 27,700. If you're single, half that, so 13,850. And then, the last two are probably relevant now, but it's 2023 numbers. If you're thinking about gifting, a lot of times the end of the year, people are thinking about gifting, but just keep in mind these are the 2023 numbers. So the annual gift exclusion has gone up to $17,000. It was $16,000 this year. And the estate tax exemption is also extremely high, $12.92 million, excuse me. So that's per person, and that's, I think, the highest it's ever been. So an extremely beneficial thing there if you're doing estate planning. So that's all I had today. So I think I'll send it back to Jennifer, and she will take it from here. Thank you.
Great. Thank you all for those excellent comments, and particularly on the tax side. There's a lot of moving parts and plenty to keep in mind. And a reminder, we do have a few questions already, but if you have other questions, please feel free to put them into the Q&A. So I'll start first with something actually that Dave and I were talking about last night. We have a question about cryptocurrencies, and Janet Yellen referred to cryptocurrencies as a possible Lehman effect. And question is sort of what would happen if cryptocurrencies do have a steep fall. And we were talking about the fact that Fidelity has now allowed retirement funds to be invested in cryptocurrency, which I personally feel is maybe not the right way to go as a fiduciary, but clearly they've had a different opinion. So Dave, what are your thoughts there?
So the question about if Bitcoin goes down further, all the way to zero, or some of those adverse scenarios. So the thought I have on that is that there are short-term risks that Bitcoin and its peer coins are all part of the risk on mood. So you see the stock market go up, you see Bitcoin go up, you see sort of risk taking. If that risk needs to be unwound or is unwound, I think you're going to see people reduce risk sort of across the board while that works its way through the system. In part, some of it is just raw nervousness. Other times it is margin calls and certain things collateralizing other things. The worst of it, in a good way, is that thus far a lot of the cross collateralization has been sort of lenders within the Bitcoin ecosystem collateralizing and lending kind of to each other, and so that has helped limit some of the damage. But the folks that are investing in these things are drawing their money or pledging collateral from other places. So I think in the short term, disruptions there are definitely worrisome. However, I think in the medium or longer term, after the dust settles, is you could have a vote of confidence back in traditional markets, and you could see asset flows back to more traditional regulated markets, the tried and true, if you will. And so the assets that have been fleeing to some of these gray markets would come back more kind of online and into some of the institutions that have been bleeding assets in a competitive way in these spaces. So short-term pain, but perhaps some silver linings in the longer term.
Great, thank you, Dave. Mike, a couple of questions for you. One relates to the mass millionaires tax, or so-called millionaires tax. What are your thoughts on that?
Yeah, so this is a great question. So obviously, Massachusetts passed with the recent elections, the $1 million, millionaires tax, as they're calling it. So this is a 4% tax on income over $1 million. So right now, Massachusetts basically has a flat tax of 5% for ordinary income and long-term capital gains, or 12% for short-term capital gains. So this will add a 4%, tax on top of that if your net income is over $1 million. So you'd be looking at your taxable income and saying, am I over $1 million? The good thing is that most people are probably not subject to that. If you are, that's good, but you have to keep this in mind. So some people have had concerns, I think, just watching TV and seeing all the ads that we saw the past month or so. Maybe if you sold a house at a big gain, you could be subject to this. So I think the idea is keep it in the back of your mind. I think talk to your tax preparer and stay in touch with them so that you can plan ahead for these things. But there are a couple things that you could do. If you have a Roth IRA, that should not be taxed. Just to let everyone know out there, if you're in a Social Security situation, Massachusetts does not tax Social Security income. And, maybe one idea I've heard out there, and again, please talk to your tax preparer about this, is it's looking like that's a per return limit. So one thing you might be able to do is you might be able to explore, should you file separately from your spouse? Maybe if it is per return, you could stretch that $1 million between two people. So please consult your tax advisor, but it's certainly something to keep in mind.
Great, thanks, Mike. And maybe we have a couple more questions on the tax and estate side. So the perennial question, will the Mass legislature ever increase the estate tax deduction? So the numbers you quoted were federal, which are nice and generous, but as we all know in Mass, that the number is $1 million. So I guess it calls for a little bit of speculation on your part, but what are your thoughts?
Well, I have seen recently, probably within the past year or so, I guess if that's recently, I believe there was I want to say a state senator that was proposing index this for inflation, or I think I've seen in the past maybe give people 2 million, something, give us something, basically is what the thought is. So I believe Massachusetts is the lowest one in the country. States around us have maybe 3 million, 5 million, something like that. That's what the old federal amount was, about 5 million. And actually it's set to sunset, I believe in 2026, to go back to about the 5 million. So it is speculative, but keep your fingers crossed, because we are the lowest one in the country for states that do have an estate tax that they levy, that they have on a state basis.
Great, thanks, Mike. So question also, one of the first questions we got relates to, knowing that today's market move was positive, and we had sort of good news from Powell, but is there an opportunity to dip our toe into concentrated portfolios, or, looking at particular out of favor sectors as a way to at least sort of leg into the markets?
Sure, I'll talk about that. I'll probably put that all under the umbrella of active management, and that it absolutely is a good and opportunistic time for those strategies. The bulk of what we do in-house involves that, as well as we will employ outside mutual funds or ETFs as needed to further underline certain high conviction themes or positions. And so the nature of the market right now is, particularly as we worked our way through earnings season, as those earnings were announced for an individual company, we were seeing pretty dramatic moves, +5, +10 for the winners, -5 to maybe -20 for the losers or those announcing underwhelming news. So it's been a punishing and rewarding season in both directions. And so that's provided fodder and fruitful hunting grounds for our equity team under Ryan Hanna and team that to do a variety of things. It's allowed us to consider buying back some of our former holdings that we sold, but names that we continue to follow and be in touch with, add to existing names if they've pulled back some, for example, or even if they're executing, we may even add, as they continue to grow. Trim some winners if they do get a nice pop, and then it's a little not as fun to sell names that maybe aren't executing as we expected, but we're doing so in order to fund a better idea that's popped up somewhere else in the market. And then of course we're launching new ideas, names that we've been following kind of casually for some time, but they've been rich and expensive. Now all of a sudden they're interesting. It's all right, let's get that work done so we can move some money toward it. So all of this is a way to express ideas in more specific areas. And I think that was maybe what was the question was asking about concentrated positions. I would say specific positions. We're doing a lot of that. And our global asset allocation strategy takes things from a more top-down way, but does do a different form of active management, but is able to express thematic conviction on things like value equities or income-bearing equities and things like that. So really, all of our strategies are able to take advantage of opportunities in this environment.
Great, thanks, Dave. And maybe turning to specific companies and the equity markets, Anne-Marie, what are the things that we're monitoring that would cause us to increase our equity exposure?
That's a great question. We're discussing this constantly, as I'm sure you can imagine. We're taking a wait and see approach at this point. We're focusing on fundamentals. We're being data dependent. As I mentioned, valuations still don't look cheap to us. We've not even seen a true capitulation. The VIX is still at 22. If we see another considerable pullback in the market, we would consider it at that point. We also want to wait and see what the effects of the Fed's tightening policy will be on the economy and the earnings. Typically, there's a lag effect to that, and we still have some time. I mean, they're still raising rates at this point, so we're not at the end of that. In prior years, we often stuck with that saying, don't fight the Fed when rates were at zero. At this point, we shouldn't be fighting the Fed either, as rates are still going up. So that's where we feel on that. And then, as earnings estimates start to come down, as I talked about in my presentation, we feel that there's still some slack there that needs to be brought down. And so if those start to come down, we will start to feel more comfortable. Even though we are underweight equities, though, as Dave mentioned, we are still fighting dislocations in the market and constantly adjusting and readjusting to have the optimal portfolio.
Great, thanks, Anne-Marie. Maybe a couple of quick hits for Mike. And so there's clearly lots of interest in the tax piece, and I don't know that we'll be able to answer all of the questions, but you can definitely get in touch with us, and we will make sure we monitor these questions and can get back to you. Question about the QCD, is that 100,000 per year or is it cumulative, and how does that work?
Yeah, great question. So that is per year. So you could do it now in 2022, you could do it again next year, 2023. So yes, it is on a yearly basis.
Okay, great. And then also looking at the federal estate tax exemption per person, does that mean if two people inherit an estate with an aggregate of 25 million, is that 12.5 million for each of them?
I guess I'd need to know maybe more the situation. What's by two people? Is it a married couple? Is it siblings of a parent's estate? But yes, generally you can think of it as per person. So if an estate is larger than that, certainly a married filing joint, a married couple can combine theirs for estate tax purposes, and your estate planning attorney can help you out with that. But I guess I need to know a little bit more of the specifics of it to really hone in on an answer with that one.
Great. So I would say for the person who answered the question, please feel free to reach out to us, and we're happy to discuss specifics and get you a more specific answer. And we have had tons of questions, which is great. I think we have an opportunity just for one more, which is a question about the role of bond funds for folks who can't buy individual bonds.
Yeah, those are still perfectly fine and appropriate. They're a little less customized and specific than individual bonds, but they are still garnering many of the same, if not, almost all of the same benefits that I highlighted earlier on just higher yields, and their underlying holdings are appropriate. We have many bond funds under active due diligence and monitoring that we recommend that are providing access to the better yields.
Great, thank you. And then maybe I'll just answer this last question. Are we seeing an increase in Cambridge Trust clients talking about moving out of Massachusetts? And I have not heard any specifics. I know that was absolutely a concern by the folks who were kind of trying to get out the vote against that tax. Having New Hampshire just a few miles away from us, I think may make it easier for some folks to consider those moves. But I don't think we've seen any specific situations yet. So I'd like to thank everybody for participating, for your excellent questions. We really appreciate the time that we get to spend to you and to be able to share some of our thoughts. Again, if you do have further follow-up questions, by all means, get in touch with us and we're happy to answer them. The recording and the slides will come up on our website in a couple of days. And then we want to take an opportunity to wish you a wonderful, happy and healthy holiday season. It's hard to believe that we are getting very close to 2023, but we hope you're able to spend some time with family and get a little bit of time away from the markets and away from the day-to-day stresses. So thank you again for participating and have a great evening. Bye-bye.